Okay, let's unpack this. If you're in the world of financial advice, you often hear UK taxation mentioned with, well, bit of dread, right? That
Yeah.
sort of dry regulatory thing in the background. But that thinking is fundamentally wrong, isn't it?
Completely.
Today, we're doing a deep dive into the source material to really confirm that taxation knowledge, even if you never, ever sign off a tax return, is the absolute engine room. It's what drives high-quality, effective, and crucially compliant client advice. We're going to distill exactly why integrating this is just essential for suitability.
It really is the foundation. Look, to frame this properly, we first have to get our heads around the UK tax system's three sort of explicit purposes. These drive every single rule, every relief, every potential headache you face. The sources are pretty clear. First, it's about funding public services, the obvious one.
Sure. Roads, hospitals, schools.
Exactly. Second, and this is really crucial for planning, it's about redistributing wealth. That's where the whole idea of progressiveness comes in. And third, it's designed to influence behavior. You know, encouraging things like saving for retirement, maybe discouraging things like high carbon activities.
Knowing those drivers is key, I suppose, because it helps predict where changes might come from down the line.
Definitely. But let's get to that core tension you, the advisor, face every day. You're not a qualified tax accountant.
No.
Yet your job is just inextricably linked to tax. So what's the essential tax knowledge boundary? What do you absolutely have to master? And why is crossing that line so critical for making sure your recommendations are suitable?
That's the million-dollar question, isn't it? Where's that line?
Well, what's fascinating here is that the line isn't drawn at calculation. It's drawn at strategy. Advisors don't calculate the tax. They don't file the returns.
Right.
But they absolutely must understand how tax interacts with personal financial planning to offer suitable recommendations. I mean, if you recommend something that turns out to be tax inefficient, the client holds you responsible for that outcome, not just the product performing well or badly.
So it's about the structure, the overall plan being sound from a tax perspective.
Precisely. Clients rely on you for that structural certainty. They just assume you know how to set up their investments and savings efficiently, avoiding unnecessary tax right from the start. This informed decision-making, that's what protects their future income, their wealth, their security, often over decades.
And if that foundational knowledge is shaky, well, the potential damage to the client can be immense, can't it?
Oh, huge. Our sources really emphasize this. Poor tax planning isn't just about missing out on a bit of efficiency.
No.
The real danger is it can severely slash investment returns over time. And, critically, it can create completely unintended liabilities for clients, stuff they never saw coming.
So tax is like this silent partner governing suitability at every single stage, from contribution through growth to withdrawal.
And even transfer, like with inheritance tax, it shakes the entire strategy.
Wow. Okay. That severity of risk brings us to the landscape itself then. What are we actually dealing with?
Right. We're looking at several major taxes that hit clients depending on, well, their circumstances, earnings, investments, goals. You've got income tax, national insurance.
The rego.
Yeah. Then capital gains tax, CGT, inheritance tax, IHT, and for business owners, you can't ignore corporation tax. Plus various duties and VAT, though they're maybe less direct for core financial planning.
And if we link this back to what you said earlier about redistribution and fairness, you can kind of see how the structure itself reinforces the strategy, yeah.
Exactly. Progressiveness is basically the operating system here. Look at income tax. It uses those increasing marginal rates as income goes up.
Right.
Similarly, CGT and IHT, they're fundamentally designed to tax the growth or the transfer of wealth that's already been accumulated. Understanding that design intention, that why, is crucial. It explains why certain reliefs exist and, where the government is trying to nudge financial behavior.
And the complexity just ramps up instantly, doesn't it? The moment a client isn't just a standard UK employee.
Yeah.
Things like residency and domicile.
This is a really high-stakes area. Now, most clients will be UK resident, taxed on their worldwide income, simple enough.
Okay.
But advisors must have enough foundational knowledge about the basics of residency and domicile to spot when a situation gets complicated. If you've got a high net worth client, someone internationally mobile, maybe someone with foreign property or offshore trusts,
Red flags should be waving.
big time. An alarm should go off. Your responsibility there isn't to solve it, but to know when to pull the trigger and say, right, we need specialist tax advice here.
And that protects the client from potentially catastrophic mistakes in cross-border planning.
Absolutely. It protects you both.
Okay, let's pivot slightly. From those sort of big principles, let's get down to the practical day-to-day tools you need to master, the allowances and exemptions. This feels like where a lot of the annual value's added.
Oh, definitely. Helping clients actually use their annual allowances effectively,
Well,
that's probably the most quantifiable way an advisor shows their value year in, year out.
Right.
Every tax year, you have this suite of tools available to cut down or defer tax liability, and you really need to understand them intimately.
So what are the key ones advisors absolutely must know inside out?
Okay, well, it starts with the foundational personal allowance, the amount you earn tax-free. And crucially, knowing how that allowance tapers away once income hits six figures, that's a big trap.
Mm-hmm.
Then you add the personal savings allowance and the dividend allowance. These dictate how you structure any non-pension savings, like in GIAs.
But I guess the really tactical planning, especially around investments, often centers on the capital gains tax annual exempt amount.
Absolutely. The CGT allowance, especially given it's been reducing and is planned to reduce further, makes it a critical piece of the advice puzzle. It's not enough just to know the number.
No.
An advisor needs to grasp the implications. Like, how can you actually use that allowance effectively each tax year? Maybe coordinating selling assets, maybe offsetting losses against gains.
Or even transferring assets between spouses before selling.
Exactly. Bed and spouse. Failing to actively plan the use of this relief each year just means permanently paying more tax on investment growth than necessary. It's a direct hit to returns.
That detailed usage, that tactical element, brings us right into the specialized planning areas where tax is just paramount. Let's start with what many consider the biggest tax elephant in the room: retirement planning.
Yeah, pensions. The tax advantages there are absolutely central to UK financial advice. The government uses tax relief on contributions to make pensions incredibly tax advantaged.
But it's not unlimited generosity, is it?
No, not at all. It comes with complex limits. Without a really strong, detailed knowledge of the annual allowance, the max you can put in each year and still get tax relief, and crucially, how that allowance tapers for high earners, well, you simply can't give compliant retirement guidance.
And the landscape keeps shifting.
Exactly. The LTA being removed and replaced with new limits on tax-free lump sums. That's a major shift advisors need to be fully across. Plus, you need to clearly understand terms like the money purchase annual allowance, the MPAA.
Why is the MPAA so important?
It's crucial because if a client flexibly accesses their pension benefits, takes taxable income, their ability to then contribute large sums back into defined contribution schemes just shrinks dramatically.
Oh, okay.
That shift has huge implications maybe for business owners later in life or people getting large bonuses they want to shelter. Miss that, and the client could face unexpected tax charges.
Okay. What about non-pension investments? How does tax dictate choices there?
While the structure still dictates suitability, think about the difference between an investment tax annually, like interest from bonds or certain income funds, versus one taxed only when you sell and realize a gain, like equities held directly or in many funds. That difference heavily affects suitability depending on whether the client has a 5-year goal or a 25-year horizon.
Right. So the context is everything.
That's exactly it. Tax protection wrappers like ISAs and pensions exist precisely to shield clients from some of those annual tax hits or defer tax on gains.
But it's not a one-size-fits-all solution.
No way. The source material stresses this. A product that's perfectly tax efficient for client A might be completely unsuitable for client B. It depends on their current income, their need for access, their long-term estate planning goals, everything.
So the advisor's job is matching the tax efficiency to the person, not just taking a tax-efficient product box.
Exactly that. Personalization is key.
Okay. We can't really talk about long-term wealth security without integrating inheritance tax, IHT. For so many clients, this is the most feared tax, maybe the most misunderstood.
It is. Definitely up there. And IHT integration isn't some optional extra for the super rich. It's a core component of advice for many people now, especially with rising property values.
So what do advisors need to know? Again, not calculating it, but...
Right. We need to understand the mechanics. We need to be able to explain the main exemptions, spouse exemption, the nil rate band, the residence nil rate band. We need to talk about reliefs like business property relief, agricultural property relief, and the strategic role trusts can play in managing future liabilities.
And critically, the 7-year rule for gifts. That seems to catch people out.
It really does. We must be able to explain the 7-year rule clearly.
So just remind us, what exactly is the 7-year rule and why is it often a planning trap?
Okay, so the rule basically dictates that gifts made during someone's lifetime, known as potentially exempt transfers, or PTs, they only become fully exempt from inheritance tax if the person making the gift, the donor, survives for 7 full years after making it.
Right, 7 years.
If they die within those 7 years, the gift becomes chargeable. And if they die between year 3 and 7, the amount of tax due on the gift is reduced on a sliding scale taper relief.
Okay, so why is it a trap?
It's a trap because many people think, great, I've made the gift, it's out of my estate, job done. They think the tax clock stops immediately.
But it doesn't.
No. Advisors absolutely have to manage that expectation and integrate that 7-year timeline into any estate planning advice involving significant gifts. It requires ongoing monitoring.
Makes sense. Okay, finally, let's touch on the link between corporate finance and personal planning. Corporation tax might seem like it's purely business-facing, but it directly impacts the personal wealth of directors and business owners, doesn't it?
It connects absolutely everything for that client group. Advisors are constantly helping directors and business owners with that critical decision, profit extraction. What's the most tax-efficient mix between taking salary versus taking dividends?
Right, that classic dilemma.
And weighing that up involves balancing income tax and national insurance on salary against corporation tax rates on profits left in the company, and then the income tax on dividends when they're paid out. Plus, you've got the dividend allowance in the mix.
This is quite a complex equation.
It is. And you also need to understand how making company pension contributions reduces the company's taxable profit, which is a different mechanism to personal contributions getting tax relief. Getting that right ensures the advice is financially sound for the entire structure, the business, and the individual, not just one part.
Okay, so pulling all this together, what does this really mean for you, the advisor listening? Our deep dive today seems to confirm your goal isn't, and shouldn't be, to become the person filing the tax return.
No, definitely not.
Your mission, it seems, is to understand taxation deeply enough, the principles, the allowances, the interactions, to integrate it seamlessly into your suitability assessments, your product recommendations, and your long-term strategies for clients.
That seamless integration, that's the real differentiator, isn't it? That delivers the high quality, the compliant, and most importantly, the genuinely client-centered advice.
Absolutely.
And maybe let's leave you with one final thought to chew on this week. Something that forces you to synthesize these concepts. Given the need to often juggle and maximize 3 distinct layers of planning, personal allowances, capital gains allowances, and maybe inheritance tax planning, what specific combination of those 3 areas creates the most complex initial planning scenario? Think about a high-earning client just moving into retirement, needing to start crystallizing investment gains.
Okay.
How does the tapering of their personal allowance because of their high income affect their investment choices? Especially when you're also trying to maybe start the 7-year clock ticking on some IHT gifts and manage their CGT efficiently each year.
That does sound like a tricky balancing act.
It is. That interaction between high income, crystallizing gains, and starting estate planning, that's a puzzle worth solving. It really tests your integrated tax knowledge.